Okay, let's start it. Okay, good morning, everyone. Welcome to the weekly voice chat again. Actually, this morning, I wanted to show my Interactive Brokers page on this portfolio analyst, but somehow they are doing this scheduled maintenance, so not able to show any numbers here. But I think it's fine. We can still use the Google Sheets that I shared, right? So that you can take a look at my portfolio in details for those who are really curious, right? So actually, before we start talking about this page, right, I just want to share. I think last crisis, right, there was March 2020. I think that time my portfolio is not like, I mean, it's much smaller than today's size. And then, the drawdown in March 2020, it was around 30%-ish. So that was really like very sharp drop, right? You can just pull up the chart and see it's really like shocking given how fast it can drop. Then after that, market has recovered. And I always, I told myself, right, I said, okay, all these small and big crises, right, it will come from time to time. And I would say, if my portfolio doesn't drop by 100,000, right, then maybe it's not considered like a correction stuff. Why I'm thinking that is that, my portfolio, when it peaks, right, it's already like 400,000 plus. So, Singapore dollar. So imagine that if I keep on building my portfolio to 500,000, right, I only need like 20% drop, and then my portfolio will have like drop from the peak to bottom will be 100,000, right? So that was my thinking. I think, let's say around late 2021, late 2020 or throughout 2021. But then what surprised me is that how soon it came, right? I mean, if you look at the portfolio or the stock market in the recent weeks, right, it's really like we can feel the stress. Some stocks drop more than the others. Some actually drop like more than 50%, right? So that's quite scary also. Yeah, that's just an opening. We can take look into the details. So for those who are new to this group, right, this Google Sheets, actually, the link is at the group description. So you can just copy paste into your browser. You can take a look at my position. I try to update this as soon as possible, which is usually within like 2 days of my trades. But bear in mind that this is just a long-term portfolio because for other short-term trades, for example, like options, like my cash, even if sometimes I use future for like short-term trades, right, I won't record into this portfolio. But then my portfolio is like confirmed more than 90 or 95% is all in this portfolio. So this is like a good representative of my portfolio already. Okay, this is just to show that, okay, what's the average price that I bought at, and then the current price, and then the P&L of each portfolio, right? Then I think this chart is more meaningful just to show you guys that, okay, in my some of my YouTube videos, I have shown, I talk about Apple, Microsoft, Amazon, TSMC, Tesla, Nvidia, all these we have discussed in the past. Then you can take a look at my allocations, right? So you know that, okay, how bullish am I on certain companies? I would say that for now it's fairly diversified because I just started up this entire Interactive Brokers portfolio since 2017. And then the single names, right, like all these Apple, Microsoft, I think I just started building up the portfolio since 2020. So it's a rather new portfolio. I would expect that as time progresses, right, let's say if there's any companies that's doing much better than the others, so the allocation will increase consistently. It will increase more than the others because I don't have the habit of like rebalancing, like selling winners and then just buy into those that drop in prices. For those that doing well, I'll just keep it. Yeah. Okay, then let's take a look at the return. This is like I mentioned, in 2017, I started to build the portfolio. I started out with ETF, and then in 2020, I started to buy all these single names. So the single names, right, stocks, right, is in red color, and then the ETF is in blue colors. So you can see that the peak, right, is in late 2021, November. So it hit as high as, I think, 440,000-ish. Let's say 440,000. And the latest one here is around 360,000. So you just minus this portfolio value, right? And plus the monies that I put into my portfolio in these 3 or 4 months, right? That's roughly dropped by more than 100,000 Singapore dollar. I think it's around 110,000. So this is how much my portfolio has suffered. I think that work out to be around 20 to 25% loss. So it's definitely larger than S&P 500. Mostly also because of the individual picks, especially those with the high growth companies. Okay, you can take a look. These are the single names that I have bought. I have total of 19 names here. So I think some are like very small positions. But if you just look at let's say this is the year-to-date returns, right? Some like Roblox, Shopify, this drop by, let's say, more than between 40 to 60%. So these are huge drop. And these are all those stocks that listed on US exchange. I still have Meituan and also Tencent listed on Hong Kong exchange, which is not available on Finviz. But those are dropped quite significantly as well, which you can see here. So I think the largest drop is Meituan. My average price is 300. Right now it's like 135 Hong Kong dollars, right? So, for this single position alone, my loss is like 10,000 US dollar. So this is a huge position and huge loss for me. Okay, I'll just stop here first just to see any questions before we move on to the next session.
Bunty, I have a question. What was your percentage gain at the peak?
I don't know how to quantify that. I think the percentage you are seeing here, right, these are not representative of the entire performance because, position that I have sold, right, it will not appear here. So this is not a good representative. But right now, because there are quite a sizable purchase that was made in 2020, let's say first half of 2020, so there's still some gains. So right now, I think the entire portfolio-wise, right, I'm still in the green. Consider this portfolio was built since 2017. But peak, I really don't know. But this percentage was much higher. I would say, like, let's say 20%. Yeah.
I see. Thanks.
If I can pull up something to help answer this question, I'll pull up from the portfolio analyst. But right now, I don't have that information. But to me, not that okay, I think that's a good question, right? Because, we tend to look at the return, like we are in stock market, we tend to look at how much we can generate the returns, right? But the way I view it, right, I don't want to pay so much attention to the return because, returns, it sounds very good, right? Okay, I made like 100,000, sounds very nice, right? But actually it doesn't help us with our financial goal, What helps with our financial goal is actually the size of the portfolio. Imagine that, let's say, this year I'm 36. Imagine that, let's say I'm 60 years old and I have like $10 million, right? It's not a problem for me to retire, right? So I can have a dividend portfolio and just receive dividends, or I can just sell like 1 or 2% of my portfolio every year and I can still retire well, right? So the key is to have a portfolio that is sizable enough for us to liquidate along our retirement life, right? So that's the goal. That's why, right, I would say let's pay less attention to the return and pay attention to the size of the portfolio. And how we are building this size, right, there are mainly two sources, right? Number one is that the market return. So let's say, keep it simple, we don't invest in single names, right? You just invest in, let's say, like S&P 500, right? Average return in the past was around 10%. Even if you just assume that the future returns is 6%, right? And that 6% will still contribute a huge portion of the growth moving forwards, right? Just imagine that you have 500,000. 6% of 500,000 is how much, right? It's already 30,000 per year. So that's a very sizable returns after it compounded to a big size, big portfolio. But before that, right, before it hits, like, let's say 500,000, right, or 1 million, right? The portfolio growth is mainly come through our contribution, the money that we put into the portfolio, right? You can hear people say, okay, I get a 200% returns, right? Then how much you have in your portfolio? I have 20,000, I have 10,000. Even 10,000, you 2x or 3x, you only earn like 20,000, right? It doesn't help. So in the beginnings, right, I would say, let's say if you are in your 20s or 30s, I think you should focus on just putting as much money into the portfolio, right? Hit a certain size, let's say 500,000, 1 million, that kind of a size. And then you can like slow down a bit, right? Because once you hit like 1 million, just having a 3%, 5% every year will give you a decent compounding return moving forward. So that's why I said I don't show return in this table for that purpose. We should look at the size of the portfolio and see how it compounds over time. The challenges is that the compounding is not like CPF, like it just continue to compound year over year. There will be some period in certain months, even in years, right, that the value will drop. Say one example, you see here, right? This I don't know whether you can see clearly because it's kind of small. Let me see if I can enlarge it.
Yeah, I can see.
Yeah, you see here, there's a I think here is close to 20% drop in the S&P 500. You can look at the line here, from here drop to here is it's like I think close to 20%. Then the portfolio also dropped, right? So you see it dropped here. But because the portfolio size was still very small back then, I can just put in a couple of thousand, then I can recoup the losses already and times to move on, right? And when the market rally, right? So it will just rally like you will see this part as very, very small. And same for this, same for this period. As of now, the scale, right, is from 0 to, let's say, 500,000. Then this drop become like very big, right? And because I will still continue to put money into my portfolio, right? So couple of thousands every month, I'll just put in. Even if market keep on dropping, I will still put it in, right? So let's say if after one period, let's say after 1 year, I'm able to recoup the losses just by putting in money, okay? Like these losses, 100,000, right? Let's say 1 or 2 years, I can recoup that, right? Then after that, when market rally, right? And this line will not stay at this level anymore. It will just go past 450,000. It will pass 500,000 in a couple of years' time now. Not saying that I'm that bullish on the market. It's just saying that we are building portfolio here. What is required is really the discipline to just keep on putting money in, right? Yes, over short period of time, you can see that, wow, market drop 5%. Wow, 10% drop. Hey, come on, 500,000 drop 10%, that's 50,000, right? How many of us here like have 50,000 like monthly income, right? I would say not many. Even if you have like 10,000 or more, that's like very impressive already, right? And even 10,000 income doesn't mean you can save 10,000, right? So you probably need like a couple of months just to like compensate for the market losses, right? But over a long period of time, market will not just like continue to drop and become zero, right? I mean, no such good deal for us, all these companies, right? I mean, we're talking about like global companies. These are the companies with very solid fundamentals, good business model, very strong moat. So you can still see that their revenues is growing, right? Even with a recession coming, they might slow down for let's say 1 or 2 years, but after that they will still continue to grow, right? So their values will continue to compound, and our portfolio for sure will compound together with the values, yeah. So this is like looking at short term is very different compared to looking at long term. Short term, yes, you can just pull up the blog or the article that you just shared, right? Okay, we can just say, okay, yield curve inversion, wow, very scary. And then interest rate hike, wow, very scary. Wow, war somehow, very scary. Like, wow, should we really like sell everything and just park in cash and just play the market timing? Sounds like a smart thing to do, like if you look at it from a short-term perspective. But over the long term, can you really like predict like when the market will turn, right? Just go back to March 2020. I can assure you, those who sold because of the COVID fear, right? Let's say they sold in March, right? Very hard for them to like just buy back, because it's so the situation was so scary that it's really like doesn't make sense to keep invested. I mean, if you look at it from a feeling perspective, right? Like just look at how much the GDP drops, right? It's really, really scary. I'll just share like, and then we haven't encountered any pandemic in the past, don't know how many, like almost a decade, right? Not a decade, that's a century, almost 100 years. So that's why I said, yeah, be optimistic over the long term now. Yeah, long-winded response on that question. Thanks a lot for the questions. Is there any other questions, anything that you guys are interested to know? Okay.
Will you sell some of those that are in the green and, I think you call it rebalancing, right? If I'm not wrong.
For the questions, I think that's a good questions. Yeah, this is my approach, right? Let me explain in a little bit more details. I think someone pointed out, right, on what is these things hiding here, right? So I don't know whether you guys can click on it because I actually put this. You cannot change what is in the spreadsheet, but this thing I don't know whether you can open up now. So my approach, right, on portfolio management is quite simple. So actually, you don't have to focus on this column. This is just helping me to like come up with a target allocation that I want. So basically, these are my target allocations. There are companies that I'm comfortable to put in more monies. For example, like Microsoft, Apple, Amazon. These are the companies that I'm comfortable to put in like 14%. Then there are companies that is smaller, right? For example, like C Limited, like other companies, for example, like Netflix. This I only put like, okay, target allocation is only 1%. I think these are just for me to have some skin in the game and for me to like just look into their business more and see whether I want to increase my allocation or not. So these are like just like a starting position for me. So, all this from here to here, excluding the ETF, right, it added up to 100%. And then by looking at how much I have, right, the investment that I have for non-ETF, right, this is 200,000. Then I just compare against my actual allocations, and I will see that out of these positions, right, which one is over allocated and which one is under allocated. So let's say if I put in money and I want to invest, right, I'll just take a look here and see, okay, which one is in the green. For example, Amazon is in the green, right, because according to my target allocations, I'm supposed to have 30,000 here. But my actual allocation is only 29,000. So I'm short, for example, like 1,000 plus here, right? So I might consider actually putting money here into Amazon just to make up for the target that I want to meet. So I think this one will help out a bit in terms of rebalancing. For example, if the share price drop, right, the value will drop, but the allocations will stay relatively the same, right? So I will actually see it as a green here, and I can decide whether I want to invest, right? Say, for example, if I see that their fundamental is not doing that good, then maybe I'll just keep it green for a while and just delay my purchase and maybe invest in other companies. So this is my way of rebalancing. Sometimes I will sell some positions and buy those that I'm more bullish on, but I will say that is relatively rare because, as I put in money, I can decide where to put in, right? So I can always buy those that is under allocated. No need to do so much on those that is like over allocated. For example, like you see Apple, right? Since I invested into Apple, the share price actually rally like quite a fair bit compared to the others. So my investment, right, is actually not that big. But because of the share price increase, the position has increased quite a lot. But if you just look at this over allocations, right, I have no intention at all to sell and to rebalance to others. I might even buy more because I foresee that their fundamentals remain quite strong. And, during this period of like there's some fear in the markets, right, money will flow back to companies that's having more stronger fundamentals. And Apple is always have a good fundamentals. So you just look at the cash allocations in their balance sheet, right? So they have no problem to withstand, let's say, like interest rate hike and so on. So So that's my approach on rebalancing. Any other questions? Okay.
Are you holding any cash at the moment?
In terms of cash, actually, no. I have some negative margin in the account. I think probably around negative, like 10,000 margin in my account. So I have no no cash buffer at the moment. So, like really fully invested at the moment.
How do you track your annual performance? Like your portfolio need to have like realized loss, unrealized loss, right? Every year. How do you know that you're making money, or how much you earn percentage wise?
Yeah, this one actually can be seen from this, but it's not shown here. But I received the report from interactive brokers. That's why I can see that whether year to date my performance is good or bad. Actually, I shared some screenshot to the group before, right? So I'm actually behind S&P 500. Let's say in the past year to date, and also in the past 1 year, I'm like a couple percentage off compared to S&P 500 now. So that one I would say is the most comprehensive one, because it even include my like short-term trading and so on, right? So that one is all in already. It will show the money-weighted return.
Okay. So how about you invest since 2017? What is your annualized return so far for this past 5 years?
Good question. I think, when the market peaked, right, in November, that number is showing quite high. I think it's in the range of 20+% annualized returns. But after that, since the market drops, right, because this actually is heavily influenced by the the current market. And if you look at current snapshots, right, later I'll put the numbers after the call. I'll just share that as screenshot. I think it's quite low. It's like in the range of like 10% or so. So it's still positive, but it's much lower compared to just 3 months back. Yeah. I don't have the numbers on top of my mind right now.
Yeah, because I'm trying to figure out, right? Because your portfolio, you have a lot of cash injection as well, right? So it's like kind of like very hard to figure out the whole picture.
Yeah. Let me explain why that number sometimes is not representative of the overall return. Because when we look at the return, there are mainly two ways to look at it. The first one, we call it the money-weighted return. The second one, we call it the time-weighted return. The difference between these two, right, is that the time-weighted returns, basically, you don't need to care like when you put in the money. Basically, let's say if you invest in S&P 500, right, you just look at the S&P 500 lines, okay? Then you say, okay, how much the S&P index has moved from 1 point to 1 point, then you can calculate the time-weighted return. You don't need to know like, okay, whether I have put in money along the way or I pull money out. These kind of things you don't need to know. That's the time-weighted return. That's the neutral way to look at the time period, right? And if you will get the time-weighted return, meaning that your money-weighted return will be the same as time-weighted return if you only invest one bullet at the beginning and then just liquidate at the end. So in that scenario, these two approaches, right, will give you exactly the same return. Okay. Then now let me explain what is money-weighted returns, right? The money-weighted return, it will be influenced by how much money and when you put into your portfolio. So if you do a DCA, right? Let's say here I put in money here, right? Across this period, right? What happened is that in the beginning, the market can rally quite a fair bit, right? From this point to this point. But I have only small money invested here because my portfolio was small back then. But as I DCA and I put in more money into the second half of this period, right? But the return from, let's say, this point to this point is much smaller than this point, this beginning point to the end point here. So what it means that if you do a DCA, right, your money-weighted returns will scale to the return in the recent period. So if you see the return is much higher if I just invest in one bullet from 2017, right? If I only started DCA in the past, let's say 12 months, right? The return might be already zero because some money is invested in when the market is in high all-time high in November, right? So this money that was deployed in November, they are making loss already. So you average out, you might already in the red, right? So that's why I said, if we tend to look at money weighted return, because that is that's what's influenced our portfolio return. Because when we put in the money actually play a role in the total returns, right? But it will be heavily skewed by the current market situations. Like if recently market has performed badly, right, then the money weighted return will be very low.
Yeah, I think I always had the impression that the time weighted return is more for portfolio fund manager, right? Because they are trying to attract investor throughout the period. So they want to tell people the investment performance, right? But money weighted is more like, to my impression, it's more for retailer because it's money in the pocket.
Yeah, exactly. Actually, why portfolio managers only look at time weighted return is because how much money that they have, right, in their funds, right, is not under their control. It's actually decided by the investors, right? Investor can pull out the money anytime they want, right? So you shouldn't penalize them for the money weighted returns, right? Because it's not their fault. It's not their fault. Because let's say if there's a lot of money flowing in November and then now they just pull out, right? Your money weighted return is very low, but that's the investor fault, not the fund manager's fault, right? So to be fair to them, they only decide how much to allocate the allocations. You should really just look at their time weighted returns. But we manage our own money. We decide how much to put into the portfolio, when to put into the portfolio, and once put into the portfolio, how to allocate the portfolio, right? All these three decisions are all decided by us individually, right? So we should look at the money weighted returns. So there's a little bit difference. So for example, if I'm managing your money now, and after this drop, right, you say you want to pull the money out, right? I said, no, now not a good time to pull your money out. You say, I don't care. I just want to pull your money. I said, you will suffer a loss. You say you don't care, right? Then pull out. Then what it means is that you decide the timing of the flow, right? What it means is that actually you will suffer this loss, right? Yeah. So I think this is quite important. So, a huge distinction. I hope this is not too technical, just to explain these points. But because these concepts sometimes can be quite quite confusing to some. Okay, let's move on to the next session. I just want to explain a bit, especially for those who are new to investing, right? I've seen people in their 20s, sometimes in their 30s, still very young. Probably you still have 50 years ahead, right, in your investment journey. But yet, every investor, we are so worried about all this month-to-month market fluctuation, right? So I just want to draw some diagram just to help out, to explain why we shouldn't be worried so much on market fluctuations. Okay, so just bear with me for a second to do this drawing, and then later please give me some feedback whether this is helpful or not. So for our investment journey, right? I guess let's say for 80% or 90% of you listening here, you probably are working, and then you are having some saving, right? And with that saving, you put some money into different investments, right? It could be deposit, it could be some bond, it could be CPF, it could be equities, or even real estate, right? Different sort of investment. But for stock portfolio, right, just focus on stock portfolio. So what happened is that this is the timeline, right? Okay. At some point we will die, right? And then at some point we will retire, right? Hopefully we'll retire early and then die not so soon, okay? And then this is just to illustrate how we put in the money, right? In terms of the flow of the money, okay? So as I mentioned, you are working now, you are doing saving, right? So let me represent this as the money that you put in, right? This is the money that you put into your portfolio, and you start to put small small number, like small volume of small amount of money into your portfolio. It could be like, let's say you are working, I don't know, 3,000 salary, you can manage to save 500, right? So you put 500 here. And then as you work and your salary increase, your saving increase, this money that you put into portfolio will actually increase over time, right? Okay, so this is the money that you put into your portfolio. And then what happens is that we want to work to an extent that, okay, now we have a good portfolio size, and then we hit the retirement. And that's when we will actually retire and liquidate the portfolio over time, right? So what happens is that you will start to retire, and then you will actually pull out your money from the portfolio over time. And likely the money that you pull out from your portfolio also will increase over time, not just because of the inflation, right? Don't expect that now you can support your living with, let's say, $2,000 or $3,000. You can do that in 20 years or 20 years or 30 years later, right? It's not possible just because of the inflations, right? So this one will also increase. So you see that there's two periods here, right? This is what we call the accumulation period, right? Accumulation period. This is what we call the accumulation period. So basically we pull out money from the stock market. Then the next questions that I just want to ask, like, given that this is the money that you put into your portfolio and this is the money that you pull out, right? If you can like plot the chart of S&P 500 or any investment that you put in, right? How would the chart looks like for you to maximize the payoff or maximize the outcome in terms of your portfolio? Yeah, maybe just think for a second. Like, do you want the stock market to move like this? Or do you think it should look something like drop? How would it look like? Or you want it to increase very fast? Like now you just started out, right? You just started out here. You are just in the first 3 or 5 years of your investment. You want it to increase very fast, right? And then just go to the moon, right? Well, I mean, what kind of expectation that you have, or what kind of chart that you want to see, right? Because what I'm trying to bring up is that if the market increase too fast in the beginning, right? And because it increased too fast and the fundamentals doesn't increase as much, right? So what happened is that it just pull the return to the current period, and then it just move up first, and then it stay high, right? It won't go up as much anymore because the market is already expensive. And because of your accumulation period within this period, right, you are forced to buy your investment at a very high price, right? Is that something that we want to see, you know? Or alternatively, you will rather the market just continue to drop, right? And that will give you a good opportunity to accumulate the investment that you like at an attractive valuation, right? And then hopefully over the long period of time, with the growth of the fundamentals, this thing will grow, right? So what I'm trying to say here is that actually the best chart that can maximize the payoff, right, is something that looks like this. It should drop very quickly and stay low for a very long period of time, just coincide with the period that you accumulate. Then right after the end of your accumulation, right, it just shoot up. This one, right, is the best payoff because you will just keep on buying here when the level is very small here, right? When the level of the index is very low, and then it just shoot up when you want to deaccumulate and just liquidate, right? This is the best outcome. But I mean, no such good thing, this is like very how to say, 没有这样好的事情不会发生it won't happen but what I think realistically speaking, right, the best outcome will be something like it should go down a bit and then over a long period of time you just move up so that you get to accumulate when it is low and then deaccumulate when the investment has appreciated. Okay, I know this drawing is become like quite a mess here, but I hope that this is a good illustration. So
is this a portfolio level or stock level?
Portfolio level.
But if portfolio level, right, if you have like 10 to 15 years stay low, right? Most people would have give up. Ideally, I think I would like the green color, right?
Yes. Psychologically,
You know what I mean?
we would want to see something that is green, that like the green color. You want to see, okay, there's some traction, then you continue to put in money, then it continue to perform, then the stock price just continue to go up. This is what we want to see from a psychological point of view. Okay. And this is usually, let's say if the price go together with the fundamentals, this is the best that we want to see. And you don't have to, suffer so much all this like emotional pain, right? But let's assuming that their fundamental is all good now. This is the basic assumption, because if you say it drops and then the fundamental turn bad, right, or war, right, something bad, something very bad turn out, right, and then it just go to zero and we just end here, right? This is the worst already, right? Because whatever money that you put into your portfolio and then it just go to zero, right? Then you got nothing left. Got zero, right? This is the worst, right? But assuming that over the long term, they are all well, right? You are diversified enough such that you don't choose the company that like you are not focusing in one or two companies and that one or two companies just go to zero, like with that, just not that scenario, right? As long as it is a solid portfolio, diversified enough. By enough, I mean it could be like 5, 8 positions, right? Or put it simply, you can just invest in index, right? It should go up over time. Then what you actually want is that it should go, you want it to go down so that you get to accumulate when it is cheap, and then it shoot up, right? It's just like the period between, let's say, 2008 to 2016, for example. 2008, there's a market crisis, right? There are people who are really scared because of the crisis and just stay away from the market for like forever, That's really, that's how scary it is during 2008, 2009. So, and that also give a lot of opportunity for those who haven't encountered any huge financial crisis, right? Those who entered the stock market in 2010 onwards, right? They'll just accumulate and accumulate and accumulate. And as the fundamentals pick up, right, then they get to enjoy this huge rally from 2010 until like 2021, right? So that's why I say the drawdown that we are experiencing now, let's say probably 15% for S&P 500, right? It could drop 5, 10, 15, 20% in the next 1, 2, 3, or 5 years. But I mean, my suggestion is that we should look at this as an opportunity rather than something that is so fearful that should discourage us from continue to be stay invested. Yeah. So that's my message. I'll just pause here just to any feedback from you guys are appreciated.
When would you decide to cash out? Because for example, let's say you plan to retire at 60, then sway 60. Let's say there's a crash, then you might feel unwilling to cash out. So would you do it, at one go, or would you de-accumulate over, maybe a 5-year period?
Yep. Thanks for the question. I think that's a very good question. And I think this question is very applicable to those who are, let's say, now 40, 45, not 40, 40 is still far from retirement age, right? Let's say if you are 45, 50 or 55 years old, right? I think this question is very applicable. The reason I say, right, I'm 36 years old, and I'm comfortable to like put in 100% into equities. And I mean, all the, I still have some money in CPF, right? So I think that's a different story and different buckets. But let's say talking about monies that I can, free monies that I have, right? Disposable money that I have, right? I can put 100% into equity also because I'm 36 years old, right? If I'm close to 50 years old, I don't think I can put that like 100% into equities now. So in terms of like the accumulation, I would say that before I hit the retirement age, right? So this retirement age, it could be like, let's say, I don't know, like 60 years or 55 or any age that I foresee that I might retire soon, right? Let's say this retire is 60, okay? Before I hit 60, right? Let's say between 50 to 60, right? Between this period, I will already start to do some saving into instrument that is not equities. For example, I might already put some money into some bond funds, as long as it's not equities. Equities, there will always this risk that it might drop 30% and might not recover for 10 more years, right? So I won't make myself, right, okay, 100% stay equity until 60 and then just liquidate from the equities, right? Between this age, right, let's say 5 or 10 years before I retire, I put some money into bond funds or just invest in some deposits, anything that is fixed income in nature, just so that once I retired, I can first liquidate this money first, right? The bonds investment. Don't have to invest I can just take the money from here first for, let's say, for between 60 to 70 years old, right? And then if the market is good between this period, right, then I can already start to sell a little bit of my equities and just park into my bond or like deposit account, just to make sure that I will always have enough buffer for me to withstand like to liquidate over the next 5 to 10 years now. So it will always be like a 5 to 10 years rolling kind of view now. Of course, if the market is good, you can just put in more buffer here, and then the market is bad, then you just stay invested now, because this money that I put in here, right, this will be like really, like how to say, if the monies that I put into the equities, right, I will not liquidate them if the market has any experience any form of drawdown. I would say this is how it works, right? This is retirement. Let's say 60 years old, right? The money that I put in here, right? This is, I invest in equities, right? Preferably, it should fund my retirement, let's say when I'm 75 to 100. I'll buy equity, I'll fund here. So this is all the equity, okay? So these are all equity. And then closer to the end, like closer to retirement age, right, I might put my money into like bond, right? And then this will fund my expenses in this region, right? You get what I mean? So what happened is that I can be assured that the money that I invest here into equities, I don't need that. I only need that after like when I'm very old. Yeah, so that I can stay invested as long as possible. If I know that I will need the money, right, then I'll make sure that that money will be invested in something that is safe, which is like bond deposits, some low risk investment. So I would say, let's say if you are 55 years old, I guess people's here, right, if you are 55 years old, I'm sure that this group of people already have some investment into something that's safer. For example, like bonds, CPF, this kind of investment. So that's not a problem. Okay, any other question? If not, let's go to Slido just to run through the question. Let me just take a look who's here, whether you guys can help me to answer some question. Okay, I won't call the names. So if you have like any opinions on the questions raised here, please let me know. Okay, so I think there's quite a long list here also. Okay, let me read out the questions. Okay, the first one from Fu. Is China really uninvestable? Baba and Tencent are getting cheap even on bearish DCF. Many studies think China will overtake us and be the largest economy. Let me see. Is ST here? ST is here, right? You want to give some comment? Because I saw you share a couple of videos and articles. Like, anyone want to share your view with regards?
Actually, I'm too young to comment on this. I just learned from a lot of videos about China, and I just do some read out of it. So basically, I would say you can try to do some research and do some read up, and then also watch those YouTube videos that I share. Yeah.
Thanks a lot for the comment. Yeah, I think this one, I think one good thing about like these two companies, right, like Alibaba and Tencent, is that, you know, recently the price has dropped so much, right? It's mostly due to some macro news. You know, like for example, like all these macro news with regards to the delisting risk. There are some people talk about like a slowdown in China. I think these are what we call macro risk, right? And macro risk, right, sometimes it's very scary because it will affect like most companies in the market. As of now, affect like quite a number of Chinese companies, right? But one good thing about macro news is that it could be very bearish for a period of time, and it can turn suddenly also, you know. It's just like pandemic situations, right? You see during pandemic index dropped by 35%. You look at individual stocks, right? Most of them also dropped by 30 to 50%, right? So they all drop together. It's not a single company problem. So then the entire market won't like go to zero, right? So as the sentiment turn, right, they all will turn together. So I think if you look at these two companies, I would say that they are just stuck in this entire bearish macro situations, right? If you can just stay invested, stay invested. If you are comfortable to deploy more money, you just continue to deploy and just take advantage of the low prices, right? If you are very bearish with regards to the Chinese regulations and you're just not comfortable to taking on this kind of risk, right? Like specifically on the delisting risk, or you don't know what the Chinese government will do, right? If you are not comfortable, then you can just stay away, right? So I think it really depends on your how to say what kind of risk that you are comfortable to take now. So this I think is not a huge problem for the companies mentioned. I mean Alibaba and Tencent, they are the largest companies in China, right? But let's say if you are investing in some small companies, like small cap, and if you look at their fundamentals, there is some serious concern with regards to their fundamentals, right? Especially if the company itself is highly leveraged, right? Then I can't say that stock price drop, then you just average down. I won't dare to make this kind of statement, you know, because for the smaller companies, highly leveraged companies, they can drop and then they can just buy. Other companies might buy out and then it become a permanent loss for you as an investor, or it could like just become insolvent, right? There are quite a number of companies like this in the past. Even just you look at Singapore stock market or Malaysia stock market. I mean, there are quite a number of examples, right, where companies just drop and then they just like bankrupt, right? Yeah. So be careful with that. But if you are diversified enough, invest in quality stocks, which I regard these two companies as quality companies, I don't see a huge concern. But please be aware of the type of risk that you are taking. Because, you know, if you say you are comfortable with the regulatory risk, and then 3 months later, suddenly the Chinese regulator just come up with new rules, right? And then there's back and forth between US and China talking about all this delisting, then market continues to sell off, right? Then you just need to accept that because this is something that you already comfortable and you are taking and you are aware of the risk, right? Yeah. Okay, that's all from me. Any other view? Anyone want to share your perspective? Okay, no, let's move on. Anyone worried about lost years or even decade? People who have started at investing at the height will not be feeling very good. Anyone interested to give your view on this? Who's like among the listener here, right? Anyone just started, let's say like less than 6 months, or let's say it's less than 1 year? Anyone want to share your view on this? Okay, no view. I'll make a quick comment. I think for this question, actually, I explained quite a fair bit when I draw the diagram, right? I always think that, if you are worried about like 1 year of bear market, right? You just have to look at, let's say you look at S&P 500, right? You just need to look at the chart and then just zoom out and then look at the period between 2000 to, let's say, 2005, and then look at the period between 2007 to 2012 or 13, right? Just look at those past period, pay attention to when the market peak and then pay attention to when the market bottom. And then you will realize that actually if we enter into a recession, right, it's quite possible that this type of market environment, it could actually extend for 1 year, 2 years, 3 years, 4 years down the road. It can actually like just become so bearish that just stay there for 4 or 5 years, right? So I think for anyone who is investing in stock market, right, why people always say that, okay, you should invest with more than 10 years horizon, right? You shouldn't say that, okay, I actually plan to buy a house in 5 years time. I just put my money into the market for 5 years and then I liquidate and then I take the money to buy houses or spend on other stuff, right? Because if your time horizon is less than 5 years or even less than 10 years, right? If you are hit with this kind of situation, then it will become a loss, right? Then it doesn't make sense to like just liquidate after you invested for 3 or 5 years and lose like 20 or 30% of your money, right? Which is very possible. That's why I would say that all these just have yes, everyone should be worried on this, and you shouldn't say this kind of situation won't happen because it can always happen. And you just need to refer to history to appreciate that it just happened. I mean, this type of things happen often enough, right? You don't need to say, okay, I need to go back to 1930s or go back to war period, that kind of things, right? You just need to look at in the past 10 or 20 years, there's plenty of examples already. And with that, we should be prepared if this happened, right? Then the next question is, if the market continue to drop, let's say like over the next 2 or 3 years, what will you do, right? Will you just liquidate and just be discouraged from investing? Or will you just say, okay, I know this sounds a bit scary and sounds a bit crazy, but looking at falling knife, looking at market continue to drop, but I'm just going to deploy my money and just buy, right? Just continue to accumulate my assets, right? And we also need a bit of optimism here, and you always have to believe that it will turn out well after 10 or 20, 30 years of time, right? So that's why I said, okay, be aware that this can happen, but doesn't mean that we should avoid investing now, especially for those who are young, right? If you only have like, let's say less than 10, 20, 30,000, right? Market can drop 10 or 20% is not a big problem from you, right? A bigger problem for those who are very young, right, will be that, you just don't invest enough and then the market just continue to rally. Then you're just like missing out on all these gains, right? I think that will be a much bigger loss. And that loss is called opportunity loss. Usually it's very vague because you don't see like the real monies, right? It's just opportunity loss, but that one is quite costly as well. Okay, I think that's all comment on this. Anyone else want to share your perspective? Okay, let's move on. Anyone investing in European companies? I think fear of World War III and NATO counter response drove valuation down. I'm looking around. Anyone here want to give any comment? No? Actually, this one, I think, aside from individual stocks, let's say who will invest in European companies, right? If you invest in VWRA, your money, let's say 60% will be invested in S&P 500, which is US, right? Then 10% will be emerging market. The rest will be like all this developed excluding US market, which means a huge proportion will be in Europe. Because other than Europe, it will be like Japan, Canada, Australia. So it will have some exposure into Europe geography. And then if you invest in IWDA, it's also similar. We all will have some exposure. And for me personally, I have invested like small proportion into ASML, right? That one is Netherlands companies. So also have some exposure. But if your fear is like all these like World War III, NATO, these kind of things, right? I would just say that actually your worry is not just European companies, because Europe, right, they are very close with US. And if you understand the supply chain, right, they are all interlinked between US, Europe, Japan, or even like China, right? All these big economies, right? Because of the globalizations, they are all interlinked. So if there's any fear of World War III or escalations of tension between Ukraine, Russia, US, NATO, these kind of things, right? Like your worry will not be just on the European companies. It will always be a global worry. So don't have to focus so much on this. Like, yes, if war happens, right, then what can we do, right? I mean, if the stock market suffer, then we just suffer along with it. We are investing in the companies. We are capitalists, right? All these companies worth certain valuation because we are not pricing in a war, right? Because if you are pricing in a high chance of war, I think all the valuation in the stock market, it should be like, you should discount 30 to 60%, right? Yeah. So I think we all just need to be optimists with regards to this. So, and I'm personally optimistic because, you know, one thing is very interesting with war is that, you know, the best way to prevent war, right, is actually to make all these countries interlinked together. For example, if US and NATO and Russia, they are all, in terms of their economy, they are linked together, right? It will make all these sanctions become very, very costly to both sides. And then it will become very hard to escalate. So actually that's the best way to prevent a war. So I think we all should be optimists and then and hope that all these countries, they are all nice to each other. And then let's cooperate on the economic fronts, right? And then let's the industry, all this economic industry be all interlinked so that we all make the cost of the war become much bigger and everyone will try their best to prevent the war. I think that's the best hope that we have. But with regards to this question, I would say that, yeah, it's just a comment, not really a question here. But I would say that no need to fear so much on war. Okay. Anyone want to comment on this? Okay, no, let's move on. Thoughts on cybersecurity for the long term and CrowdStrike moat. I don't have a view on this. I'm looking around. See, Gavin, you want to comment? Are you here? Or is there anyone else that want to comment on cybersecurity and CrowdStrike? Okay, no insight from me, so I'll just pass. Let's say if anyone has any insight with regards to cybersecurity or CrowdStrike, feel free to like PM me, let me know, and then maybe we can arrange a session to talk about this. I think this is very niche area. It's very hard for me to comment because I don't have much insight here. Okay, let's move on. Latest China inflation stay at 0.9% based on this outlook. Will China reduce interest rates this month? Okay. Anyone, any Chinese expert here?
Yeah, maybe I can take that.
Yes, yeah, Leon, go ahead.
Yeah,
go ahead.
I just joined this chat. Yeah, so basically, they are targeting 5.5% GDP this year. I think a lot of street view is that it's a bit an aggressive goal, considering the whole Ukraine-Russia crisis also. And they have the housing crisis in China to actually solve for. So basically, I think there will be a pressure to reduce interest rate to boost monetary policy in China. But I think regarding monetary policy versus fiscal policy, I think the China's government view is always towards fiscal policy because they are quite prudent. They don't have the exorbitant privilege to print money like the US. So I think they will reduce interest rate, but not to the extent of what the US is doing. Yeah, so there's a diverging sort of monetary policy between the West and the East.
Actually, in your view, right, people always say that, okay, US, they can just print, even Europe, ECB, they can just print, right? Why China can't do that, given that their economy is not small, like as compared to all these Western economies?
Because right now the settlement, right, is still mostly US based, and a lot of the finances in the central bank reserve, they are still using US as the primary trade currency. So because of the capital control in China, they are trying to prevent foreign capital from hot inflows and hot outflow to destabilize the economy. So by controlling capital, there's not a lot of offshore rent being circulated around. So not a lot of people are keeping rent as a reserve currency. So they can't really print money as much as US. Because when the whole world is relying on US dollar as the primary currency, right, everyone has a skin in the game. So US can actually use this to their advantage. Because if they hurt, the whole world will hurt together.
Yeah, actually, in the past, let's say a couple of years, right, we have seen that people are talking about like China try to prop up not to prop up their currency, like it's more like develop their currency, develop their economies and their monetary system up to the standard that they can serve as the reserve currency, right? And it's also included in the IMF, what they call it, I forgot the name.
The special drawing rights.
Yeah, the special drawing rights, right? So is there any development on that front?
I think they are still trying to slowly liberalize their currency, but in terms of stock market, they open up the Hong Kong exchange. But I think they are still quite cautious in terms of foreign investments. So until they open up that whole capital control, I think rent will still not be used that widely yet. But as they can see from the Russian case, right, the whole SWIFT sanction and how US is trying to weaponize their currency, I think they will slowly shift towards rent. But I think they will develop the central bank digital currency first, so that they can have a blockchain to track where the spending is going to for the rent side of things.
Yeah, this one, the central bank digital currency, I think also mentioned quite a few times in the past, right? Is there any timeline or do we have the clarity on these things will happen now? I haven't followed this very closely.
No idea, but I think the government is trying to push it ASAP so that they don't have to depend on the dollar so much. Actually, with this they call it CBDC, right? Central bank digital currency. Actually, it's quite good because they link the blockchain ledger technology together with a unit that the central bank can actually back. So actually, there's quite a lot of use case for it, because from the government standpoint, they can see where the fund flows are going, so that they can tweak their monetary policy accordingly or their fiscal policy accordingly. And in terms of, let's say, supply chain, they can see where is it sourced to.
And the unit of this CBDC is same as yuan, right? That's how it works, right?
Yeah, so that's the idea of it. Basically, the central bank will issue out to the banks these digital currencies.
Yeah, this is very interesting, right? It's a bit like the stable coins kind of concept, right?
Correct. Just that you have the blockchain ledger to actually record the transactions that are being done in digital rent. So, I mean, if you want to do funky things, you still keep cash. But if you are keen, then you will use CBDC and do not be worried about it. That's the basis.
Yeah, very interesting. Okay. Thanks a lot for the comment. Please help me with the coming questions because today I think it's only me. I'm afraid that this become
only you carrying the conversation. I just joined.
Okay. Let's move on to the next one. How to calculate free cash flow for banks? Is it even called that? I think this one I'll pass to you, Adil. I don't have insight also on this.
Free cash flow for banks. I think banks are quite special in the sense that Yeah, it's not like a normal operating company. There are two components of the revenue. First is net interest margin. Basically, what you earn from your balance sheet by loaning out to customers minus away the cost of funds from your deposits or your bonds. So that's one major component of commercial banks or saving banks. Then you have your non-interest income, which is all your fee income, like your credit card charges, the fees that you take from advising on M&A deals, capital market deals when they raise equities on the equity capital markets or the bonds on the debt capital markets. So these two are your main revenue stream per se. Then after that, you from these two revenues, you have to minus the overheads, which is mostly your staff cost. Staff expense is usually your main bulk of banking. Then minus away your office space expenses and your IT overheads and stuff like that. Then after you minus away, you get what is called the pre-provisioning operating profit. So when you run a bank, you have to keep like a certain level of capital in case the bank toll. So basically, the central bank will require all your different banks to hold a certain tier 1 capital and also like tier 2, tier 3 capital. So every year, the bank will check their books and see whether they are funky debt or not. And then they will run a model to sort of like assess whether there's credit risk in their books. And with that, they will come up with a level of general provisioning as well as a specific provisioning. So in terms of like in 2019 and 2020, there's a lot of general provisioning because banks were worried that people would default because of COVID. So they actually overlay a lot of general provisions. So that will reduce your PPOP, pre-provisioning operating profit, down to your net profit, profit before tax. Then after you pay your tax. Yeah. So in banks you don't really see FCF per se. You see more of your net profit, or PPOP. But so to be on that, right? Post-COVID, actually a lot of banks, they were very cautious. So they actually did over provisioning. They set aside a lot of sums in case the books go haywire in 2019 and 2020. So this actually hit their net profit quite a lot, accounting wise. But actually 2021 onwards, they realized that, with all the government measures, actually my book is not hit that hard. So in the case of US banks, they have been writing back a lot of profits. So you could actually see that net profit rising. Yeah. But in Singapore case, the local banks didn't really write back that much of the provisions because they want to, they cannot be shown to, optically speaking, they cannot be shown to profit from the crisis. So they have to slowly write back the book. Yeah. What else to add? Yeah, in terms of our local banks or banks in general, given a rising rate hike environment from the Fed, right? So just now I mentioned that there's two components of the revenue for banks. One is the net interest margin, and second is the non-interest income. So with the rate hikes, assuming that your cost of funds are still the same, banks are expected to increase their net interest margin. So that's why there's a lot of investors flowing to banks for now. That's all from me.
Oh, thanks a lot for the very detailed explanation on how the bank's balance sheet and their income statement works, right? Yeah, I think you brought out a very good point with regards to banks, which is that, this free cash flow concept might not be that useful, but we can look at the net income, right? But the net income itself, because there's this huge component on the provision part, right, which is totally not under our control, right? You can just do all this historical analysis and find that, okay, this banks is investable. And then in 1 year, when all the fears is here and suddenly the bank will just say, okay, I need to provision more because I might see that the non-performing loan will increase in the next 1 or 2 years, right? And just with one provision alone, it could wipe out the entire net income for the year, right? So that all this scenario could always happen, and it can happen very fast, and it can happen in a huge amount of provisioning can be set in just 1 year, right? So if you are investing in banks and you want to have some insight on like something to point you that this will happen and you want to sell your bank stocks before that, I would just say that it is actually very hard to do so because, everyone will try to guess what will happen in the future, right? The bank themselves will try to guess whether their non-performing loan will actually increase next year or in the coming years. So that's also why, let's say if we compare different sectors, right? Let's say if there's any recession coming, bank stocks will be one of the first one to get hit first, and then other sectors will get hit later, right? So I think that's the risk of investing in bank sectors. But if we want to look at it from a long-term perspective, yes, no free cash flow, you can still look at the net income and try to see whether they're at a healthy level or not. So, yeah. Thanks a lot, Leon, for the...
Yeah, I think in banks, a lot of CFO, in terms of their outlook for the year, they will always have a target return of equity. So I think that's the more correct metric to look at. But if you want to track whether their book is healthy or not, you will look at the credit costs in terms of basis points, how much they actually attribute, and also non-performing loan percentage, as you mentioned just now.
Yep. Thanks a lot. Let's move on. People always point to China and Russia saying that they aren't investable due to its politics. Warren Buffett and Charlie Munger say that they don't invest based on politics. Why? Maybe you break this into two parts of, I don't know, the first part that say they are not investable, and then the part that say they don't invest based on politics. Anyone want to give your comment on why China is not investable? No comment here. Everyone think that is investable. Let's go for more China. Yeah, maybe I share a bit on these views. Okay, there are so many different views, right? If you follow Twitter, watch YouTube here and there, I'll just name one that the one that I remember at least. So I think the one that I remember is that, okay, they say if you invest in Chinese companies, Chinese regulators, they are not like US regulators, right? They can do things in a very sudden manner. So one regulation, if the government want to do it, right, you just have zero doubt whether they can pull it off, right? They will just pull off before you realize about it, right? So this is why, if you're looking at it from a company perspective, if you don't have enough time to react, right, and the government can just do whatever they want, right, then for sure it is a concern, right? Because some policies that the government enact, it could be something that hurt the business. For example, some industry, the regulator has been like try to guide the market towards lower profitability just to help out with some certain market, right, or certain segment of the economy, right? So as soon as all these companies that receive the guidance from the government, they will just follow, right? Because they can't fight the government. Whereas for US, right, I mean, the rule in terms of their regulations, or everything's are like more stable because they are already in this for a long period of time. And if the government is trying to do something that's funny, right, all these corporates, they have some influence on the politicians, and they can try to shape the regulation in a way that will protect their interests. So I think this is the main difference if you are comparing, let's say, US market versus Chinese market. But does that mean that Chinese market is uninvestable at all? So I think still come back to the same thing, same picture, right? Because if you say, okay, like this, that means that, okay, US market is just much better. It's not the case also, right? Because regardless of where you invest, right, there will still be risk that you are taking. It's just that different type of risk, right? For example, like if you invest in US market, I mean, generally speaking, their valuation is higher than Chinese market, right? So if the valuation is high, then, and you invest in that companies or that market, then you are taking on a valuation risk, right? Because, for example, you invest in a market that is having PE of, let's say, 35 or 30, right? the business can still be solid, and just because of the valuation drop, right, from 30 to 25, and then you will suffer a loss. Is that a risk? Yeah, for sure, it is a risk, right? Valuation can always change. And what's the risk compared? The PE drop from 30 to 25 versus a PE from 15 drop to 10, right? For sure, the higher the PE, the valuation risk is higher. So it's just a different type of risk, right? That's why if you look at the investor around, right, different people have different appetites towards different type of risk. There are people who just not willing to take on the valuation risk. The moment they see that the PE is like 40, right, they will just stay away. They say, it's too expensive. I'm not comfortable to take on this valuation risk. I just stay away, right? Then there are also people who say, okay, if I invest in Chinese companies, the government can do whatever they want, and I can't even foresee what they will do next. It's just too unpredictable to me. I'll just stay away, right? So I think all this, is fine, right? It still come back to what type of risk that you are comfortable with, and then you just do accordingly. So this is one with regards to the uninvestable part. And then let me also comment on the second part on why they don't invest based on politics. I think this one you might want to like just listen to like Berkshire shareholder meetings. Let's say you just watch in the past 3 or 4 years, right? If you can just watch further back, I think that's even better, right? Then you will have a sense on their worldview in terms of their investment and so on, right? I think 2 of them, right, Warren Buffett and Charlie Munger, they don't invest based on politics. They don't invest based on macro. It's because they invest in business. I think even Warren Buffett, he explained and reiterate again in the latest shareholder meetings, right? So he just said, I'm looking at the business. If the business have good fundamentals, have the moat, right? That means they can defend against their competitions, right? They have some pricing power, this kind of attributes, right? Then they will just invest in the companies, right? So they don't try to predict like how will the macro environment looks like, how will the politics environment looks like, these kind of things. They try to avoid that, not to say these are the things that is irrelevant or will not impact the share price, right? For sure they will impact, right? I think Buffett also explained that if the interest rate just go up by, let's say, a couple of percent, right? All the valuation will get hit, and then his portfolio will also get hit, right? All this, what he's trying to say that this will have an impact to the stock performance, to the share price. It's just that they don't have any insight or any edge with regards to macro prediction or with regards to politics, environment predictions. They focus on what they know best, which is on the fundamentals of the business. So that's why they will say, okay, and when we say about all these fundamentals, I think they focus a lot on the cash flow generation of the business and also whether they can maintain the pricing power. I think these 2 will be two of the most important factors that they are looking at. As long as these 2 are good, right, they don't really care whether where they are, where this business is located in. Because other stuff, they have no edge at all. And for example, if they don't have any edge in the predictions, right, they will just say, okay, this is in the too hard pile, and they will just forget about it and just focus on investing in companies that they know best now. So this is their approach. Doesn't mean that this is the only approach, right? If you look at their investment, you will see that they don't invest in quite a number of tech companies, right? Because they don't understand these companies inside out. So they are not managed to pull out the buy decisions. Then they'll just stay away, right? Out of like thousands of companies, they are staying away from thousands of companies, which is also fine, right? But they have the track record to show that they know what they are doing now. So I think that's very important now. Wow, become solo talk already. I'll stop here. Any insight from anyone else want to share a perspective on this?
Are the accounting practices of other countries the same as that of the US? That's the other big question.
Yeah, I think this is that's true also. Different countries, just different accounting, different disclosure requirement. I mean, you can just compare Singapore versus Hong Kong versus China versus US. all these are different, right? So there are pro and con. Yeah. If all this is important to you and it's become a concern, right? I think stay away is like perfectly fine, right? Yeah. And it's the funny thing is that there are people who say that Chinese accounting is like not transparent and so on, right? There's also friends that investing in Hong Kong markets and then they look at the US financial disclosure. They also say that US disclosure is not as good as Hong Kong one, right? So I think that there's a bit of qualitative judgment there, like different opinions with regards to the disclosure, right? So yeah, you just have to be comfortable with what you are investing. Okay, I think let's move on. Market keep dropping, use lots of leverage, lost a mortgage on my house, what to do, how to recover. What's the meaning of lost the mortgage on my house? Can someone explain this to me? Anyone can explain this? What's the meaning of lost the mortgage? I thought the mortgage is the money. Say I buy the house. My house is 300,000. I borrowed 200,000. How do I lost the mortgage on my house? I'm a bit blur.
Maybe this guy went to invest his 240,000 and then lost the whole 240,000 that he borrowed out from the home equity.
Yeah, I actually don't. maybe like I'm guessing now, right? Maybe do some refinance and then take the money and invest and lost huge portion of the money, right? I really don't know. I don't have any good advice. I'll just reiterate the same message that even like YCX also mentioned in the past, right? Which I also mentioned the same, right? I mean, for those who are using interactive broker, it's not a big problem for you just to like turn on the margin, just to make sure that if you put in like 1,000 or 2,000 in, you can just invest directly. You don't have to wait for the cash settlement, right? But you need to keep that margin as a percentage of the portfolio at a very low level. Don't just level out like do this kind of crazy things. Yeah, it's very crazy when you use lots of leverage. So I'll just stop here. I don't like not enough details to comment a lot on the situation here.
What do you think is the most stable asset right now? Like the value will not fluctuate up or down type of asset, other than cash, you know. Like the value is very stable to cash and will not fluctuate up and down. Maybe plus minus 2% in a year, that kind of.
Yeah, I think I mean, just forget about like the real value first. If you benchmark according to nominal value, right, then the simplest one should be cash. Other than cash, it will be like some short-dated bonds. You know, it could be deposit, it could be money market funds, some short-term bond funds.
IBKR can buy bonds?
It depends on how you see it, you know, because I imagine for the listener here, you could come from, let's say Singapore or let's say Malaysia, right? If you care about like really preserving the value in your local currency, which is like Singapore or ringgit, right? Then you have to invest in the currency that is in your base currency, right? Which is Singapore or Malaysia ringgit, right? Then IBKR doesn't help. But let's say if you are comfortable to invest in US dollar and you have some confidence on like the value of US dollar will not depreciate a lot against your local currency, right? And then you have a lot of more will not depreciate a lot against your local currency, right? And then you have a lot of more other choices. For example, like some short-term bond funds, short-term bond ETF in USD denomination. But I will actually discourage you from doing so is because, you know, you are preserving the value in a sense of relative to US dollar. Like let's say if your base currency is US dollar and you invest in a short-term USD bond funds, right? Then you have low volatility. But let's say if anything goes wrong, right? US dollar can always depreciate against, let's say Malaysia ringgit or Singapore dollar, right? Then you are not getting a high return and you are taking a huge FX risk by invest in this kind of instrument. So I would say I would discourage you from doing so. If you can try to invest in the bond funds or money market funds in your base currency, that should be the first choice. And just max up like all these, like all these bank high yielding instruments, right? I don't know what they call it, like all these multiplier, DBS multiplier, all this Sing Life, just to max up this kind of investment first. And on top of that, if you want to invest in some bond funds, you can do that. I wouldn't encourage against the US bond funds unless really your base currency is US dollar. Like you are free to go anywhere in the market to retire, right? Then that's fine. Okay, I think I will just move a bit fast here. There's a couple of questions, but we won't cover all. I'll try my best now, okay? Because now it's 12 o'clock already. Broad China, Hong Kong tech keep falling, keep buying, but keep falling. Is it still worthwhile to hold on? I think this one I've commented above. Anyone else have any insight on this? Yeah, I think to add on this is that still come back to the target allocation that you want, right? Because I'll repeat again, please don't just average down just because the stock has dropped. I think this is in general not a good way to invest. I wouldn't say this is stupid or what, because you see, right, some people will say that the stock price has dropped, why are you not investing, right? But I just think that you should buy according to your saving rate, and then you should have a target allocation that fit your profile or your belief, right? Come back to the initial section where I went through, like, for example, this is my investment portfolio. I have certain target allocation. Preferably, I want this target allocation to be in the target that I want. Of course, that target you can change over time. But I don't want to suddenly, having this kind of pie right now, and suddenly 2 years later, you will see that actually I have 50% of my money invested into, let's say, pick one name, right? Let's say in NVIDIA. Suddenly 50% in NVIDIA next year. And why 50%? It's because NVIDIA keep on dropping $10 or $20 every month from now. And because it dropped, right, I forced myself to buy. And it dropped, I forced myself to buy, right? And then become like a 50% of my portfolio. It doesn't make sense, right? Because the target weight, right, it should correspond to your conviction on the company in terms of how much return that you expect from this company. And also you should consider the risk that you are taking, right? It's just the risk and the return of that company. Then you determine your target allocation. And it shouldn't be the price action in the next 12 months, right? Because what happened is that we want over time, those companies that do well, right, they should give you like 100, 200, 300% kind of gain, right? But those companies that actually not doing so well, you want it to be as small as possible, right? So that's why you should just try as much not to react based on the price actions. Yeah, so that's why I say don't try to like succumb to this, like, wow, the price keep falling, you force yourself to buy. Keep falling, then you force yourself to buy. I don't think that's a good way. At least that's not my approach. Try to resist the temptation to average down. You should pay attention to your other holdings, which might not drop as much, right? You should also buy some, be more balanced when it comes to allocations. And if you don't know how to do all these things, then probably just do indexing also is a good idea. Don't just I explain, keep buying and force yourself to buy. Okay, just stop me. Let's say if you have anything to add on. If not, I'll just continue. Many say stagflation coming up. How to prepare for that? Buy gold or crypto?
Stagflation, if really is a stagflation, then all you can do is buy food and commodities.
Yeah, I think that's very true. Actually, here I can share a bit some story. Not sure if I have shared before. I don't think so, right? Actually, the current situation, right, with regards to Ukraine, Russia, and then we already see that it hit two two areas quite badly, right? The first one is the energy market, and then second one is the commodities, for example, like wheat, right? All these food sources. Actually, if you look at this situation and you just extrapolate, it's really quite worrying. The situation might turn bad, like become worse over the next 6 or 12 months, right? It could happen. But actually, you don't really need to look far, like you don't need to imagine what could happen, You just look around, right? There will be some countries that's already facing this. Yeah. Have I mentioned about Sri Lanka before? I don't know whether I mentioned before. If I have mentioned before, please stop me. Because I know Sri Lanka's situation is quite bad. Their inflation, which is just close to 10%, let's say 3 months or 4 months back, it is now at 16%. And then their food inflations, right, is already between 30 to 40%. And their government is doing all this capital control, meaning that if you hold their currency, right, which is the LKR currency, you can't actually go to foreign exchange and just exchange to US dollar in the hope that that can actually help to preserve the wealth. That is actually illegal. Only, I mean, in the past, foreign exchange only is allowed for those who are going overseas. Let's say if you are traveling, and then you need to show some proof that you are traveling, and then you can also exchange to a certain limit, right? So there's a very tight capital control, currency control. You can't do much. So you see, they are in a country that is already in a bad situation, right? Things can turn very bad, and the government already run out of money, and you can see that, right? Because Sri Lanka itself, right? They are, in terms of energy, they are net. They are really importer. So they need monies to buy oils, and then use that oil to generate the electricity in the country. And the country run out of money. They don't have money, or like literally they run out of money. So what happens is they don't have money to pay for the oil. No oil, no electricity. No electricity means that they have to cut down their they have to ration the electricity usage. So outside of their capital city, right, which is Colombo, right, they only have 8 hours of electricity per day. So 16 hours, no electricity. So what to do, right? So, that kind of situation is that, this is like truly like stagflation scenario. What happens is that if you only have 8 hours of electricity, actually quite a number of business, they can't run already. For example, like restaurant, your fridge also cannot use if you only have 8 hours of electricity per day, right? Some businesses, small businesses already closed down just because of this, right? Business closed down means that people lose their jobs. I mean, you don't have to like study a lot of economy to understand that they are already in such a situation, right? And for those who talking about all this CPF situation, right? Like, okay, will Singapore government just reduce their CPF rate from 4% to whatever percent, right? Actually, you just need to look at Sri Lanka. So what happened is that, they also have their like their version of CPF fund, right? The government will, this is not real, the government already said, out of the X percentage of the investment return for their CPF fund, right? A portions, right, will actually just taxed by the government, and that money will use up by the government to help with their fiscal. This is like literally taking the monies from the CPF, which should belong to their citizens, right? They just take the money and put it into the government coffer and just help out with the fiscal. So, I mean, you don't have to imagine stuff. You just look at what is happening now. There are countries that's already in these situations, right? And just to echo on the view that YCX just said, right? In that scenario, what happens with the peoples, right? So, it's really by just buying commodities that can help out with the to hedge the scenario. So what happened is that, people there, there are limit on how much rice that you can buy from the supermarket. Let's say you can only buy 2 bags, right? They will just go to the supermarket, even though they have enough rice. They will just buy some. buy food, and then just store at home, because you know that with that kind of inflation, right? If you just store your wealth in the form of your currency, then you just like inflated away, no? I mean, you don't preserve the real value of the currency, no? So they will just buy stuff, anything that can last longer period, right? They will just buy stuff and just store it at home, no? And you know, when this crazy buying happenings, right? This is what we call it would like spiral towards hyperinflation, because nobody want to keep cash anymore. The interest rate given by bank could be like 10-15%, and people don't want to put their money in deposits, right? Because they are literally looking at their currency notes turning into like toilet paper, right? Yeah. So that's the scenario for hyperinflation. It is very, very scary. If you read all these articles that came out in the past 1 or 2 weeks saying that we are experiencing stagflation or hyperinflation, this kind of words that come out, I just want to tell you that this is definitely not the case. As you're still comfortable to keep your money in the banks, right? That's not the scenarios that is so worrying. You know, when you are holding cash on your hand and you just want to dispose the cash and just turn it to something else, right? Okay, that's the scenario that we are talking about. And
but having said that, the situation can turn from good to bad very, very fast.
Yes.
It's just like you just see in 1 week's time, you look at Russia, basically the economy just disappeared. Yeah. Just literally just disappeared. It's not even in a recession or downtrend, it just disappeared.
Yeah, that's true. It can turn very fast. Yeah, we need to be careful on that. What to do? Maybe buy some commodities, precious metals. I don't know if you are really worried. I think that's the way to go.
The idea is that also if you buy all these commodities, like even if you buy gold, right, and you try to transport the gold outside of the country, you know that all the countries, they will always have those declaration, or if you carry too much gold, they will confiscate the gold and stuff like that. Then it becomes that you cannot even transfer your value out. So like there's also the case where if you look at Argentina, there was Argentina don't know default like how many times already. They are over the last 30 years or something. And the businesses that invest in Argentina, right, they even when they do their transactions in USD cash, they are not even doing the Argentina. The Argentina government can still say, oh, you are not allowed to transfer the USD cash out of our banks. And then they are unable to transfer the money out. Then they start to think about ways to actually convert the money into assets or commodities and shift it out. And they will start to think, oh, can I just buy gold and transfer it out? Answer is also no. Can I buy like other metals and transfer it out? Answer is also no. Then it becomes like they get to the point whereby they might even consider buying just like cars or buying boats and whatever just to drive it out of the country or things like that. Yeah.
Yeah, that's true. But depending on the scenario that you are trying to hedge, right? Let's say if your goal is to transfer out of the country, then I would say maybe like all this like cryptocurrency, Bitcoin is the way to go, because you don't even need to like carrying the physical wallet, right? You can just memorize your the 24 words code, then you can just transfer out, right? I think that's the scenario that you try to hedge. But let's say if that's not the scenario that you say, okay, it might be some stagflation, I will just stay in my country, and then how to preserve my wealth, right? Then you will come up with different alternatives, right? It really depends on the scenario that you try to hedge now. Okay, let's move on. When will Russia war end? Any insight? Wow. Is there any geopolitical expert here?
I think there's a lot of propaganda put out by the Ukrainian to show like, oh, they are doing this and that. But if you look at the actual map of where Russia has taken over and things like that, Russia is actually slowly, even though they are experiencing losses here and there, they're actually still advancing. It's just they are advancing slower. So it's really a matter of like right now whether the advance will stop. If it doesn't stop, then eventually they'll take over Ukraine. There's nothing much can be done there.
Yeah, thanks for the comment. Yeah, I do agree with your statement on the propaganda. I think it's both sides, both on the Ukraine side and both on the Russia. You can also see, I would say that like 90% of what we are reading on Twitter, right? I think how much can we believe, right? I'm a bit skeptical on that. But come back to these questions, right? I think, let's say if you are very frustrated on these situations with the war, right? I say, because of war, then now we are having all these different problems, later hit on the supply chain, then hit on and you know, so many sectors, and you're feeling this, very frustrating. I would say that, yes, maybe through, the war at some point, they might actually like come to an end, right? But this tension between, let's say, US and Russia, I don't think it will end that soon. So just be prepared, like this tension or like maybe a little bit of escalation from both sides, right? This one, it could actually last for quite long period of time. I mean, just come back to go back, like let's say during Trump period, where you see there's this trade war between US and China, right? I mean, easily it dragged for 1 or 2 years, or even until now, you can still say there's still ongoing trade tension between these two countries, right? So I think this is like, you know, following Ray Dalio's video, you understand that this talking about like, okay, rise of different power, right? I mean, this kind of tension is quite common. And then I think we all just need to be like, just get used to this kind of environment. Don't get discouraged, because, you know, with changes, there's always opportunity around, right? And if this tension causes some uneasiness or some fear in the market, there's always like opportunity for us to invest, right? So try to see it from a positive perspective. Don't be too frustrated because of the war. I mean, we should be sympathy on the victims there. But I mean, coming from, for those who are outside, like, investment perspective, right? I think just be prepared that this will drag on. Okay, let me read out the next one. Any thoughts on using leverage during this fear market condition? I've said this. 5CX, anything to add? Please don't touch about the call options. don't leverage. Yeah, I think come back. You see S&P 500 now, it's just like what, 15% drop from the high, right? It could drop 25%, could drop 35%, right? It could drop 45%. Why leverage now, right? I'm feeling very funny when people ask this question, like, has the market bottomed already? Like, the best answer is that it's 50-50, right? I mean, you can look ahead 5 months, look ahead 1 year, look ahead 2 years. It's always like 50-50, or you can argue it's like 55%, it could go up, or 45% it could come down, because it drifts upward over time, right? But don't just like having this thinking that market has already bottomed, hence I need to leverage up and I need to take advantage on this dip and it will go up, right? Don't have that kind of how to say that mindset, because it's very dangerous, you know, and it will get very stressful when you thought that market has bottomed and then it just dropped another 10% from there. So don't make your life so stressful. Please prioritize your sleep, okay? Inflation in USA now staggering 7.9%. What can we do from here? No insight. I have shared all my view with regards to this. Anyone else want to share, like, on this? Any comment? Boon Song, Keith, Mr. Maximus, any insight here? Next one, ways to endure bear market. Hey, double click. Oh, what happened? Yeah, just now that one I have already shared, right? How to endure. Just say, see any bear market as an opportunity to accumulate. And as long as you still plan to accumulate for the next, let's say 10, 20 years, right? It shouldn't be a problem, right? If you are concerned with the outlook of the market, what you should think of is not to sell your investment and stay in cash, right? What you should think of is maybe just be prepared to like work longer so that you have even more buffer for your retirements, right? Or try find a ways to increase your active income, right? Yeah, that's my suggestion. Next one, what are the potential ways banks can be disrupted? Actually, I think we discussed this in the chat. I don't have more insight, but let's say if we are able to get Mr. Lu from 1M65, right, then we can discuss this topic in more details because he's involved in you know, like some fintech. There's more. He has more visibility and more insight in terms of what are all these fintech is doing, right? So whether they can really disrupt the banks or not, I think we still need to see, right? But based on the discussion that we had last round when we discussed about like different values that was provided by banks, right? And then see which are these services or values that is provided can be easily disrupted. I would say the response so far is like, let's say 60% actually thinks that not so easy because they are not so easily replaced. But there's always that 30 or 70% that could be replaced or already slowly been replaced. So some disruption will come, but to the extent that will make banks become worthless or zero, I think so far the consensus is that it's not going to happen. Yeah, that's all. Anyone want to comment on this, or anyone from banking? I'm smiling here. want to chip in a bit on here on this question? Okay, no, let's move on. How can our stock portfolio profit from stagflation? Wow, I think we discussed, nothing more to add. Stagflation is very tough. You know, the stagflation is made out of two words, right? You have inflation, and then you have some sort of recession at the same time. So imagine that the companies that you invest in, right? It could be Singapore stocks. It could be like S&P 500 stocks, right? You see the revenue keep dropping, and the revenue keep dropping. All these expenses also you are not able to cut because of the inflation, right? Then earnings for sure will drop, right? It's very tough environment for stocks. So please be prepared. If you're investing in stocks, this is the worst environment to be in. But you put your money in bonds, also you will suffer losses from a real value perspective. So this is a very tough environment. Yeah, commodities is the way, but how much you want to spend buying a block of gold and just park it in a safe, right? You do your own allocations though. Okay, next one. Facebook can buy. Actually, anyone here invest in Facebook? I don't recall. I think it's good to have those who invest in the company to talk about the companies, right? Honestly, I can't recall anyone here can comment on this stuff. Maybe I'll just say, maybe you can just listen to the Monish Pabrai interview. I think there's a interview that he just gave that talk about Facebook, and then he's quite confident that even excluding all the metaverse stuff, right, they could just easily double in a couple of years' time, right? So I think that's a very bullish view on Facebook. Then after that, you understand the bullish argument, try to think of a couple of bearish argument, and then just do your assessment on this. Okay? Any other view on this? If not, let's pass. Any good books recommendation? I think for this question, let's all together need some help from all the gurus here. We do a compilations on this, and then see. I think we compile in the past, but in the form of text, right? So let's do one more update. Then I think this is very helpful for those who is especially new to investing. I don't want to run through my what I'm remembering now. I think we need to compile. Okay, the next one. Rivian cash holding is about 50% of its market cap, but they also just cut their production guidance by 50%. Thoughts? Well, Gavin, you ask question. Usually this type of question, I will just hit it back. Like just ask you there. I don't have any insight. I haven't looked at the Rivian balance sheet at all. I don't even know it's like so cheap now, like 50% of their market cap. But one thing for sure is that they are very smart to raise their capital at a very high valuation. That's why, they can have a huge cash buffer now and the market just revert back to a sensible level, right? I think this is quite interesting. But the question is, you still need to come back to like the valuation, right? Meaning that in this sense, PE doesn't make sense. They don't have earnings, right? But what another metrics to look at is no EV EBITDA also, right? But what we want to look at is that you should take the market cap, right, minus out the cash positions, right, and look at that business value, right, and compare that business value versus like how much we are expecting them to grow, to ramp up their production, and then to get some some profit or some cash flow out of the business and do some discounting back, right? And that present value of that cash flow, you should compare against this like the market value minus the cash positions, and then do like just divide them and see what's the ratio, right? But you still need to come up with this like the outlook in terms of how much they can grow. And to me, this one is a bit hard because they don't even, I think prototype wise they already have, right? It's not a concern on that. I think their next challenges is how to ramp up their productions, right? From the current, I don't know how many cars they're producing now, right? From 1,000, can they actually ramp up to 10,000? And from 10, can they ramp up to 100,000 cars, right? I think that's the, I don't know how strong is their engineering team. How can they pull it off or not? These things is not that easy.
I just want to ask, any one of y'all take out cash on your portfolio and then put inside CPF? Like, let's say if you're above 55 and you can take out anytime.
You mean do the top up into CPF?
Yep. It's like you take out loan on your portfolio and then you put inside CPF. Let's say, because the loan interest, we fix it at 1.5% now, okay? And your CPF OA is at 2.5%. Then all you have to do is to make sure that your portfolio value is, how you put it, delta neutral, right? Then you just earn that 1% from the CPF gains, right? While tiding over the whatever market. Because if let's say you're above 55 and you can take out that 2.5% anytime, your CPF OA, then you can effectively use it you can park your cash. If you can make your portfolio in your IBKR as delta neutral as possible, then you can park your cash inside the CPF to get that 2.5% while paying the 1.5% interest, let's say.
I don't know the details rules, but let's say the money that you put into the CPF that way, right? Can you withdraw it anytime that you like?
Yeah, OA you can withdraw anytime, but there's also a limit to how much you can put in. So let's say you can put in 37K per year or something. So you can at least you still have 37K per. You can just borrow out the 37K and put it inside.
Yeah, I do see your rationale, which is like try to arbitrage the yield difference compared to the CPF, right?
Yep.
Yeah, I think. Okay, I don't know. Anyone else have any insight on that? You can share first.
Okay, I share a bit over my end. I think it depends on what your strategy is at 55. So one of the strategy that people propose is doing SA shielding. So my ideal scenario is that I will max my RA using the SA shielding. So during the shield phase, I max out my RA by transferring whatever OA to RA, and then I have my ERS down at the RA. And so the idea is that whatever balance in the OA, I will transfer out, and I unshield my SA. So now in my ideal scenario for CPF at 55 is two main engine running, which is going at 4%. And I think that's the optimum level that you can make it run. And if let's say you want to do the other strategy of building the OA, right? The issue is that the money go in is easy, but to come out, right? First you need to deplete your SA, which is the higher yielding 4%. The idea is whether you want to do it as a retirement for personal retirement purpose, or you want to do it as a legacy. So you have seen that I think in 1M65 people sharing about how they build the OA to substantial sum, and then they intend to draw using interest. Those are legacy planning. But legacy planning also means that you are not optimizing your resources in that sense, because when you pump in all the money in OA, is blocked by SA, which you need to draw first before you can touch it back. So you need to have that understanding first before you deploy the strategy of pumping excess cash into the OA.
Yeah, I understand that part. So what I'm actually talking about is, let's say you have, I just give a numbers example. Let's say you have like $1 million, okay, and you have $1 million, and maybe let's say you put in like let's say you will split over your lifetime. You build up $1 million, and you have like 80% of it in stocks and 20% in CPF. Reasonable lah. So you maybe have about 200k in CPF. Quite a reasonable assumption. So right now you have 800k in stocks, and you know that the value of these stocks, let's say you just put all into an index. So maybe it has dropped by 10%. So 800k, you probably minus 80k already. So you have 720k, right? And what you want to do is that and you have this let's say you are 55 and you have this CPF thing over here, which allows you to put in like, let's say, an extra 37k per year or something, right? Or whatever number is 37k a year, and you can put it in and you can get collect that interest on it, minimum of 2.5 and 4% for SA, 2.5 for OA. Then what you can do is that you can effectively just over the next 10 years, 55 to 65, you can transfer 370k from your stocks all over to your CPF without losing the exposure to the stocks, because your stocks you are still holding it. It's just that you are borrowing from it and putting it into the CPF, and then you are collecting the interest from the CPF. Correct? So that's what I'm saying as a strategy that can be done. And let's say at the same time, you are still getting like some amount of money from your income or whatever. Anytime if let's say the stocks just go too low, then you just plug in more to make up for the loan requirements. But at the same time, you are not really losing anything because you already borrow out that money and put into CPF OA. And at any point, if let's say the market really goes very bad, and let's say maybe your stocks portfolio lose 50%, let's just take that. So maybe it goes down to 400k. At the very least, right? You can, and you have an income. You can actually think about it as like, oh, at the very least, I'm actually buying the stocks. I'm buying more of the stocks. I'm putting more cash. But at the same time, the cash that I really withdraw to loan out, right? I'm actually gaining. I've actually taken out a portion of it and put it into CPF, and I'm actually gaining from it. So it's actually offset, and overall it's still a net gain compared to, let's say, just putting it, your stocks parked over there, and the 800k maybe just lost 50% of its value to 400k, and you did nothing. Yeah, so that's what I'm looking at to see how the numbers balance out.
Yeah, I think like for myself, right, I have my CPF, still have some small amount of money in my CPF, even in the OA account, right? So like I done the calculation also, right? Because, putting in CPF, I get the 2.5%. And then if I just use the margin in the interactive brokers, right, the margin rate is so low, right? So let's say if I can withdraw if I can use the CPF OA money and just invest in like S&P 500, right? I'd rather not do so. I'd rather just leave the money there, earn the 2.5%. And then if I want to get the same exposure, I just leverage up my interactive brokers and I can get the same exposure, right? I do see that it makes sense just to take advantage on the difference in the interest rate. But just need to be careful that if you have a portfolio of stocks and then you take up the loan, meaning that you margin in your broker account, right? And the money is out, right? Then you really need to be careful with the margin requirement and liquidations. Because, sometimes all these rules change, parameter change, and then suddenly they can just close your position at whenever they like it, right? This one, I think, is quite dangerous. So you need to have sufficient enough buffer in the broker portfolio. And then to a certain extent, you can do a bit now. I think not huge issues, right?
Right, and let's say you have, because anyway you can only do a maximum of 37K a year. So let's say you just take whatever amount your portfolio is at 55. I'm sure people have somewhere between 0.2 to 2 million or whatever amount that they have, and they can slowly just borrow against their stock portfolio in IBKR and just put it into a CPF. And because when they put it into a CPF through that top up, right, which is 37K, it tops up into the OA, SA, and ideally you never have to withdraw it, because if you withdraw it as the SA 4% first, but if you do have to withdraw it, you can at any point in time, because you are above 55 and you can just take it out. So the risk over there is pretty low, and you're only parking in 37K a year. Yeah. So you can just slowly just borrow out that amount. If let's say you have a sizable portfolio in your IBKR and just loan against it and get that 2.5%, and you pay that whatever 1.5. I mean, at most it goes 2%. You are still gaining that 0.5% out of it. Then if you can do that, you are effectively gaining that 0.5 to 1% of interest. Yeah.
Yeah. I think one point I want to add here is that please bear in mind that this IBKR margin rate, right, it is pegged to it is tied to the I think it's LIBOR or something, some short rate, US short rate. So, now we are talking about rate hike coming soon, right? In the coming week, right? A couple of months later, let's say by end of the year, right? This margin rate will also increase. And then let's say the delta between this margin rate versus the crediting rate that CPF is giving, right? It might already become like zero, You don't have that arbitrage opportunity anymore when it comes to next year. So just to add on that.
But maybe CPF goes up as well.
Yeah. Anything else? Anything that you guys want to discuss or want to ask? If we can stay on for 5 more minutes. Because just now there's one question I saw on the phone also before we close the call. Yeah, the person asked whether I have short-term positions of futures to hedge my long-term portfolio. I mean, for those, I shared this but just for clarity, I shorted the futures for a couple of weeks, and then I already closed it with some small gains there. And right now, in terms of my short portfolio, right, I don't have any futures. I only have like a couple of sell put options, like those very safe one, like very far from the current price, the market, and very short maturity as well. So these are like some nickels, collecting nickels in front of the steamroller, But I'm not doing any kind of hedging in my short-term portfolio. It's not like I'm showing you I'm staying invested in the long-term portfolio, and then on the other side that I'm not showing I'm doing the shorting, right? It's not the case, just to let you know. Okay, that's for the transparency sake. That's all I have for this week. Anyone else have any comment? If not, we end the call. All right, no. Thanks a lot for everyone who has commented and joining the call. Then see you in the next one. Thanks a lot. Bye-bye.